In this video, I will be going over how to invest your first $1,000 in the stock market. Investing is a great way to secure your financial future, and starting as young as you can is the best way to allow compounding to have its maximum effect and allow you to make as much money as possible. But getting starting with investing can be hard or kind of a daunting task to begin. So in this video, I will be trying to give you some tips on what you should be doing with your first $1,000 to help you get started with investing. So I would recommend putting your first $500 into an S&P 500 ETF. And so this is pretty much a security that tracks the performance of the 500 largest companies in the United States. So it is market cap weighted, which means that the larger the company is, the higher percentage of the ETF that it takes up. So pretty much this is a great way for you to ensure that you are initially diversified. So one stock doesn't have too large of an effect on your portfolio, and B, you will just get the returns of the market. There isn't any individual stock picking involved with this. Your portfolio, or this $500 in your portfolio, will perform exactly the way the stock market does. And this is good because a lot of new investors will struggle to beat the market using individual stock picks. And so half of your portfolio will just generate the returns that the stock market does over this time. And so that is definitely good for a new investor to just get that. Normally about 7 or 8% per year is what the stock market has returned. So you can likely expect that on average you'll be getting around 7 or 8% per year from an S&P 500 ETF, and that is great for a new investor. However, putting money in an ETF won't allow you to learn about investing, and it's kind of boring. So for the next $250, what you are going to do is pick a company that you like. Maybe you use iPhones, so you'd want to put the $250 in Apple. Maybe you wear Nike shoes, so you'd want to put the $250 in Nike. Or maybe you like Coke, so you'd want to put the $250 in Coke. And these are just examples. Pick any company that you like. Ideally, it would be a larger company that pays a dividend. You don't really want to be messing with penny stocks at all, so ignore those. And just pick a larger company, maybe AT&T, or any what's called a blue chip company. So these are pretty much large companies that pay a dividend. And if you like any of those, then just pick one and put the $250 in there. Since you are a newer investor, you are likely not going to have the skills needed to analyze a company yet. So picking a company that you like that is a large company that pays a dividend is the best way to get into individual stock picking, and this will be a great learning experience for you so that in the future you can learn how to analyze companies better and be more successful with your individual picks. And for the remaining $250, you are going to keep that in cash for now. You don't want to invest that yet. So now what you want to do is follow that first company that you picked. Say you picked Apple, you're going to want to read their earnings reports, listen to their earnings calls, read up on all of the news surrounding the company so that you're very, very knowledgeable about it. You're also going to want to learn as much as you can about investing. Read popular investing books, watch videos on YouTube about investing, just learn as much as you can. So after you've followed that first company for maybe about 6 months and you feel that you've learned a lot more about investing, it is time to start looking for a second company. So maybe you will find a company like Gilead Sciences or a company like General Mills that maybe wouldn't have come to mind originally for a company that makes a product that you use, but now that you know how to analyze companies a bit better, you find them and you think that one of them is attractive to buy. And again, these are just examples. Try and just stick to larger companies that pay a dividend when you're initially investing. These companies are a lot safer. But it can really be any company that you think is attractive after you have learned how to analyze companies better. So before you buy that second company, you are going to want to reevaluate your first company. So this is the company that you just bought because you liked a product that they made. And so when you reevaluate them, you might find that you don't like them anymore, and that is totally fine. You can choose to sell your shares in that company, or you can hold on to that company. It really just depends on where you land in your reevaluation. And then what you're going to want to do is buy that second company after you've reevaluated the first company. So whether you're going to be putting the full $500 into that second company because you don't like your first company anymore, or whether you are going to put just the $250 remaining into that second company. All just depends on whether you like the first company still. And don't just sell the first company because it went down or something. Really look into it and evaluate it. And decide whether or not it is worth holding. Don't just evaluate the company based off of its price movements. But there's a good chance that you're going to like your second company more than you like your first company, because the second company is the one that you picked after learning how to evaluate stocks. So then the final thing is you are not going to want to trade a lot. Try and stick with these companies for as long as possible, especially with these small amounts of money that you're putting in them, $250 to $500. For me, I use Fidelity as my brokerage, and they charge a $5 transaction fee. So $5 to buy it and then another $5 to sell it. So that's really going to eat into your returns if you're trading a lot with small amounts of money. So really try and pick companies that you can buy and hold on to for many years to come. So your portfolio should still have that initial amount that you invested in the ETF. You're going to just want to leave that there. That's going to continue to grow with the market, and then it will have either one or two companies depending on whether you keep your first company. And so I will say, if you don't keep your first company, you are going to lack some diversification because half of your portfolio is going to be in one stock. So I would encourage you to try and keep it in two stocks, even if maybe you sell off the first company and then buy two new companies. That would be okay as well, because you really don't want to have half of your portfolio in one stock. But since it is such small amounts of money that you are trading with, just because you're a beginner and you haven't gotten larger amounts of money where you can trade without having fees be a large amount, it will be fine if you initially lack some diversification in your holdings. I hope you enjoyed this video. If you did, drop a like down below and consider subscribing. I make lots of videos on the stock market.